You know what it is. That's right. It's time to talk money with your money nerd and financial coach. Now, tighten those purse strings and open those ears. It's the Money Talk with Tiff podcast.
Hey everyone, and welcome to another episode of the Money Talk with Tiff podcast. So today we are on episode 90. So if you've been following the podcast, you know that every 10th episode we do a question from the listeners. So today I'm doing Tiff's take. So I do not have a guest, but I do answer one of your questions. So the question that I have today is, what is PMI? So if you have ever bought a house, have a mortgage, or thinking about buying a house, you may have heard of private mortgage insurance. That is what PMI is. Now, PMI is typically required for anybody that purchases a home and you're making a down payment of less than 20% on that home. So it makes it better for people that can't afford a 20% down payment to actually get into the home of their dreams. But of course, with everything, there are downsides to this. So in this episode, I want to go over, what PMI is, what it does, and then also what are some positives and some negatives with it. So let's just go ahead and hop right in. So with PMI, if you can't afford to do 20% down, which is like the gold standard when it comes to buying a house, you will probably be required to pay PMI. Now, with PMI, what this does is a type of insurance, but it does not protect you as the consumer. It protects the lender. So this has nothing to do with, like, let's say, for instance, you can't pay for your house. They still going to foreclose. They're still going to get it. And so this does not protect you in any way, but this is a way for people to get into their houses if they are unable to do the full 20%. Now, when you get into private mortgage insurance, there are a few different ways that you can pay for this premium. Okay. So the first one, which is the most popular, is when it's borrower paid mortgage insurance. So what that means is, after you close on your home, every month you have to pay an extra premium price. And, it's usually like $70 or something like that. Don't quote me because it varies, but it's some amount like that to where you have to pay every month on top of your actual mortgage and your insurance and all that other good stuff. So typically, if you do have escrow, it's included in your escrow. And you have to keep paying that amount until your house is worth 22% more than your original purchase price. So for instance, if you bought your house at, let's say, $110,000, then you have to pay PMI every month until you have more than 22% equity in your home. Now, you might be saying, oh, well, that's not too bad. And it's not too bad. But if you look at the math, if you add up all of those years that you're going to have to pay, unless you expedite your pay down, it can add up. So that's why a lot of people do suggest that you just wait until you have the 20% down payment. And then we'll get into some ways around this, right? But let me go back to the different ways that you can pay this private mortgage insurance. So there's the borrower paid mortgage insurance. That's when you close, and then you pay every month thereafter. Then you can do, the second thing is the single premium mortgage insurance. So what that is you pay your mortgage insurance upfront in a lump sum. Now, either that's done in full at closing or financed into the mortgage by whoever's financing your mortgage. So that's another way that you can do it. Another way is the lender paid mortgage insurance, which is similar in that the lender will technically pay the mortgage insurance premium for you. But of course, they bake it in and, typically a higher interest rate. So that way they can make some money off the top too. So that's the third way. The fourth way is the split premium mortgage insurance. So what that means, and this is the least common type, but it's a hybrid of the borrower paid mortgage insurance and the single premium mortgage insurance. And so what that means is you pay part of the mortgage insurance as a lump sum at closing and then the other part monthly. So those are the four ways that you can pay your private mortgage insurance if you have a conventional loan. Now, a lot of people say, well, some people, I'm not going to say a lot because that's overgeneralizing, but some people say, well, with FHA loans, you don't have to pay private mortgage insurance. Well, I'm here to tell you that that's not true. They just have a different kind of mortgage insurance. And with the FHA, it's called MIP. So it is the mortgage insurance protection or something like that. But anyway, it's the same. It's the same concept. But for FHA loans, it's if you have a down payment of 10% or less. So for instance, with my house, I do pay the mortgage insurance every month. And unfortunately, because they changed this rule, if you have an FHA loan, you have to pay the mortgage insurance over the course of the entire loan. Now, when you have a conventional loan and you're paying private mortgage insurance, you do have the option of, telling your lender that, hey, I'm over 22%. Let's go ahead and do something. Sometimes they will cancel it for you just if you put in a request. But other times you may have to refinance. And that's a way that you can get out of the FHA requirements. So if you have an FHA loan, and let's say you get to 22% equity or whatever, then you can simply, and I say simply kind of loosely because it's not a simple process, dude. Buying houses is not simple, but you can refinance into a conventional loan, and then boom, you don't have to pay private mortgage insurance anymore. So that's another way that people kind of do it for a little while just so they can get into their house, and then they might refinance their FHA or refinance their conventional loan. So that way they can get out of paying private mortgage insurance. Now, like I said before, it does add up over time. So you definitely want to keep that into consideration when you're shopping for mortgages and when you're thinking about buying a house, because that's one thing that I had no idea about until I stepped into buying a house and going through the process. And when they said private mortgage insurance, I'm like, what the heck is that? And why do I have to pay this extra thing every month? But it is very, very common. I don't know the stats or anything about that, but I would say that most people have to pay PMI in one shape, form of or the other. So definitely educate yourself on what that is and, what that means for you as the purchaser. Because like I said, sometimes you have to pay for it the course of the entire loan. So you just want to be educated on how it all works. So I hope that answered the question of the listener. And if you have any questions, please feel free to submit your questions. Because like I said, every 10th episode, I will be answering your questions instead of doing an interview. And I love getting those questions in because y'all have some good ones. So that's pretty much what private mortgage insurance is. And like I said, if you have any questions, feel free to put it in the comments if you're on YouTube. If you are listening, feel free to hit the blog and put it in the comments there. I would love to answer any questions that you have. But thank you so much for listening to the Money Talk with Tiff podcast. And if you're on YouTube and you see my shirt, it says it's the debt free for me. Those shirts are available for purchase on the website. Definitely check out my whole line of shirts because we always want to talk money and we always want to get that conversation started. But I hope you all have a wonderful rest of your day. And don't forget, PMI. Bye.
Thank you for listening, joining, and being a part of the Money Talk with Tiff podcast this week. You can check Tiff out every Thursday for a new Money Talk podcast. But if you just can't wait until next week, you can listen to previous podcast episodes at moneytalkwitht.com or follow Tiff on all social media platforms at Money Talk with T. Until next time, spend wise by spending less than you make. A word to the money wise is always sufficient.